Hi, welcome to T Minus Retirement, the podcast where we help launch your retirement into orbit. I'm Jay Cole,
And I'm Dustin Watts.
and in today's video, we wanted to talk about how to avoid a potential tax um time bomb, so to say. And this is going to be referring to listing out your beneficiaries when it comes to your IRAs or even your 401k. So any type of a retirement type account. Now, normally when open up an IRA, they get it funded. When they list out their beneficiaries, if they're married, the primary tends to be their spouse, and then they'll list their contingent. Usually, it's going to be their kids or brothers or sisters if they don't have any kids, or anyone in their lives specifically. But normally they'll list out actual named beneficiaries on the accounts, and we've gotten a lot of questions, especially recently with some clients asking, well, should I just list my trust as the beneficiary of the IRA account? Because, for whatever reason, whether it's they are constantly changing the percentages and it's easier just to do it on the trust end, or if they want to retain some type of control with their beneficiaries on how much should people get, how much they should get a year, certain percentage. It's all over the place. It can get pretty complex, but we just wanted to talk about why you would want to list an IRA, or excuse me, a trust as an IRA beneficiary, but also talk about the tax consequences of doing that too, and just making sure if that is what you want to do, then to do it rightly.
And before we get to the trust aspect, Jay, maybe let's just talk a little bit about why you would want to consider listing, named individuals as the beneficiaries. And probably the biggest thing is just ease, and ease of the people accessing the funds. There's no trust to kind of go through. You can just list whether it be your spouse or your kids right onto the account. They get access to it very quickly and easily. We don't have to go super in depth with all the rules on, how they take money out over the years, but especially a spouse, you really do want your spouse to be the primary beneficiary if you have a living spouse, because the spouse, unlike children or brothers or sisters or what have you, they really have the most options when it comes to claiming an IRA from a deceased spouse. They can actually just retain that as their own. And
Mm-hmm.
I would really never recommend a spouse giving that up, unless there was some obscure circumstance. But, naming the individuals directly is always a very good option. It's very straightforward. But like to your point, and that we can get into, you don't have full control as to if you were, if those people do inherit the accounts. You can't really dictate anything after death, unlike a trust. But there's a lot of things to know if you do end up going the trust route, like we'll get into.
Yeah, and I would say the most common for if you want to have a trust as the beneficiary, I would say, especially if you have younger kids, maybe you want to say, the kids, they'll get the money when they're 25. So then if you die before the kids each reach that age, then the trust then takes the assets and they hold on to it until the kids turn 25, and then they can start distributing what's remaining, left from those assets. So that'd be a reason why. Maybe another one would be to um, essentially pay for grandkids' tuition. That's one we've heard too. So the reasons why are all over the place, but the bottom line is, if you as the IRA owner want to retain control of how the money is used, then that's where a trust would come into play.
I also saw too another valid reason that I had read. If you have a child who has, a mental incapacity or something like that, where they can't control the money on their own, or they're getting certain benefits that you might not want to disrupt, that might be a good reason to have a trust as the
Yeah,
beneficiary also.
yeah, exactly.
So, really the main point that we came up with here, as if you do list the beneficiary being your trust, Probably the biggest thing that you do want to consider is make sure that it's a what they call a look-through trust.
Hmm.
That really allows the beneficiaries to get the money ultimately. And there's a lot of provisions in here when it is a look-through trust, but what qualifies as a look-through trust are a lot of just your typical trusts can be considered a look-through trust. But one point that I wanted to note, something that could disqualify your trust from being considered a look-through trust and ultimately being probably the most inefficient manner, if it's not considered a look-through trust, is if you have a like a charity as a beneficiary, they won't consider your trust to be a look-through trust, and that causes the biggest kind of tax time bomb there, as to you would have to distribute the whole account in 5 years and pay all the tax, and that would be a pretty inefficient way to go
Yeah.
about it. So you really need to make sure that if you are going to list the trust as a beneficiary, you're doing so for the right reasons, like we talked about, but also that you have the right kind of trust that can assist the beneficiaries and ultimately achieve what you're intending.
Yeah, and another thing with the look through trust, and this will apply to most revocable living trusts right now, but the trust has to become irrevocable at the time of the owner's passing.
Right.
So if you have just like a family living trust, and once both spouses pass away, that trust now becomes irrevocable. Generally, you can't change any stipulations in that trust because both of the owners are deceased now. That should qualify or should help qualify the trust to be a look-through trust. That with the beneficiary stipulation, um, and as long as the trust is valid under state laws, which if you're getting it done by a lawyer or you know, one of those professional trust preparation firms online, that would qualify as well. But yeah, like you said, the beneficiaries, all of them have to be um, humans in a sense. It can't be a charity or an organization or even partially that. So if you have 3 kids and you want to give 25% to a specific charity, then the whole trust now doesn't become a look through trust because you have 25% going to a charity, even though the majority is going to go to your kids.
Yeah. So ultimately, you want it to be a look through trust. And then with the Secure Act, there have been some changes to, the rules around how you can distribute that money. And it was a little bit more favorable, certainly before the Secure Act went into effect. But ultimately, there's a couple of different types of look-through trusts. Did you want to get into that, Jay? The
Yeah,
conduit trust and accumulation trusts?
yeah. So with look through trusts, you essentially have two different types, like you said, conduit and accumulation. A conduit trust essentially means whenever the trust gets a distribution, like an RMD distribution from the IRA, they're just passing it straight to the beneficiaries. So you can treat it like the beneficiaries getting it themselves. It's just going through different hands. So it goes from the IRA, the inherited IRA, to the trust, and then just directly to the beneficiary. No stipulations at all. No oh, like the beneficiary has to be X amount of age or has to do certain things to be able to get it. They get it when the money is distributed to the trust. So it's essentially going from one to the other. That's it. And then with a conduit trust, when it comes to taxes, it's pretty much the same as if you just listed the named beneficiaries on the IRA. So if the RMD was 20,000 and it's a conduit trust, it goes to the trust, and then the 20,000 goes straight to the beneficiary, and then the beneficiary is on the hook for paying taxes for the 20,000. So depending on what tax bracket they're at, they paid at their rates versus the trust. So that's a conduit. An accumulation, that's going to be where you have the stipulations in place. So let's say that in your trust you have it spaced out or spelled out that, well, my beneficiaries can't get access to this money until they're 30, let's just say, and let's say the kids are 20. Well, the trust is going to get the RMDs. The trust itself is going to pay taxes, which we'll talk about that in a second because that is different than individuals. And then once the stipulations now become in effect, So let's say the beneficiary is now 30, then the trust will distribute the remaining assets that it has after it paid taxes to the beneficiary. So, like I said, that's going to be if you want to enable some type of control after death on how your beneficiaries are going to get their money, or what they need to be doing to get that money, essentially. But the problem with that is if it is an accumulation trust, the tax rates for trusts are they're a lot worse than just individual tax rates. So what I mean by that is that the highest tax rate for a trust, federal wise, is 37%. And unfortunately, you hit that top tax bracket for the trust once the income is above, it's a little over 15,000. I think it's 15,760. So if you have a 20,000 IRA distribution going to the
You're
trust,
getting nailed.
you're getting nailed on taxes. Yeah, because the trust
Yeah.
itself has to pay that high 37% plus whatever state taxes, and that's almost 50% of it gone.
Yeah.
Whereas if your individual rate is only, heck, let's just say 22%, that's still a lot less than 37%.
You know, I can't see a lot of people doing this, like having trust be the beneficiary, unless they have a very valid reason. Most people, I would say, they want things to go easy and smoothly, certainly after their passing. And I think that's why most people end up just putting the named individuals that they would like to on
Yeah.
the account as beneficiaries. And I still think that that's really the best scenario in 9 out of 10 cases. Everybody, the beneficiaries can deal with it in their own time and their own tax rates, and certainly more favorable than trust tax rates. There are going to be those cases if you have a very large estate, very large IRAs, or you have, let's just say, a complicated family structure, maybe where you do want to consider that. But really, the point I think to get across is really make sure that you understand what is going to happen, how it's going to work, and also one thing we didn't mention, that the make sure the trustee that's going to be the successor trustee of the trust knows what they're in for, because
Yeah.
this is a lot of work, a lot to know, and a lot to be responsible for, which is not for everybody. And it needs to really make sense in your overall estate plan.
Yeah. Yeah, because even if you just have it as a conduit trust, it's essentially the same thing as just listing out the beneficiaries, because it's
Right.
actually worse, because now that successor trustee has to file a tax return every year. They have to
Yeah.
make sure to get the money out to the beneficiaries. Whereas if you just have your named beneficiaries on the IRA, they're the ones that deal with the IRA themselves. So they take the money out themselves. They deal with the tax consequences themselves, and it's a lot smoother versus having that third party manage everything.
Yeah, I can't imagine, for the average millionaire down the street, so to speak, that has their 401k and IRA that they've saved, and they have a great balance. And they have just kind of normal family structure, that would make a lot of sense. Maybe if you have $50 million in an IRA or something, and you want to get a little bit more nuanced, and you can pay attorneys, all day to figure everything out. Maybe that can make sense, but uh, there's a lot to know when you get into all of this, and there's a lot of nuance. That's why, you really need professional estate planners and attorneys to design these things, and honestly, probably administer it too at some point, because it gets
Yeah.
very complex.
Yeah, it's good to let your beneficiaries know of how things are set up, just so they're at least somewhat in the loop. Because
Yeah.
if you do all this without telling them, then the trustee might be confused, the beneficiaries are, maybe they don't even know where your accounts are or just how things are listed, and it can cause infighting. It's good just to be on the same page with everyone that's involved.
Yeah, I think as we close it out here, a lot of times simpler is the best way to go.
Yeah.
If it can make sense for everybody, we always want to make things as simple and quick and easy as possible. Nobody wants this overly complex scenario if you can avoid it. So
Right, right. Yeah.
awesome. Well, Thanks for getting into that, Jay. I think that was a lot of good info as people are deciding, how to set up their beneficiaries on all these accounts. We hope that you guys, the viewer, also got some good information out of it. If you did, please like, subscribe, and we look forward to seeing you in the next video. Take care.